Hi. For those of you that have not seen the previous videos that we've posted, my name is Rob Santini from Financial and Corporate Services. This is video number 5 in a series of instructional videos that deal with life assurance, investment, business investment, general, retirement planning, etc. Okay? Now, this particular video deals specifically with business assurance component. As per previous videos, please note, I'm not a video maker. I'm going to make ellipses and ignore. Also, you're going to see me looking up occasionally. I haven't gone crazy. I just happen to have a control above me where I need to look because I'm maybe switching between a document and a video. Okay? So, enough wafting. Let's get on with it. What's the relevance of business assurance? It's to do with partnership assurance, whereby partners take out the life assurance on each other, so that if one of them dies, they can pay out the deceased's estate. The contingent liability is to do when you go as a company to the bank to borrow money, be it a bond or a revolving loan. Bank expects you to be covered in the event of your death, hence you take out a policy and you cede it to the bank. Then lastly, you have key man assurance, which is basically where either a shareholder or an employee or director, doesn't matter who it is a key man. Key man says it all. In other words, if that person dies, disappears, or whatever the case may be, in terms of disability, illness, or death, that business is going to go pipe. Simply because you need to be able to replace that person. You can't in a hurry, hence you need working capital to carry you through the period that it's going to take you to replace that person. Okay? Now, advising people in business is a lot more than just the insurance side of things. Okay? It's an all-encompassing side of it. Okay? Very much where you're absolutely able to hold that client's hand and guide him in certain areas. Now, if you look at my CV, you'll see that I put down that I've got a degree in the School of Life, a doctorate in the School of Life, not a degree. This is the highest possible master's degree. Okay? Because that degree was earned with blood, sweat, and tears, and one hell of a lot of money. It is probably the most expensive degree in the world to have. You cannot beat experience, make no mistake. I've been in the insurance business for 38 years now. However, I've done many things in my life. I'm a qualified bodybuilder. I had my own panel beating shop, which went bankrupt. Okay? Why? Because the interest rates shot up in those years to 27%. Couldn't carry it, so it went down. I've tried many things, some good, some bad, some whatever, but in all of them, learning very expensive lessons, make no mistake. And those lessons can serve you well. I'm more than happy to impart those lessons if you become my client. Now, when people go into partnership or into business, if you are able to start a business on your own, then you don't have to worry about partners. That's great, because then obviously you simply have to worry about yourself. And often that makes it a lot less complicated. Okay? But in many cases that is not possible. So often people of like minds get together and decide to start a business. You could be mates, you could be family, and generally what happens is that people get together on a handshake. Okay? Because they're big mates, they know each other, they like each other, they are so excited about the new business, and they just gaat voort. Okay? But here's the problem, is the fact that people change. So your partner who said to you that he's going to do X, Y, Z, doesn't do X, Y, Z, and you get pissed off, or vice versa. There's lots of reasons why people fall apart. Jealousy, outright fraud, incompatibility, You name it. There's many, many, many reasons why people fall apart. The problem is that before you engage with a partner, you've got to make sure that certain steps are followed. And step number one, above everything else, is you have to put together a decent agreement. A decent agreement is not, I've seen so many agreements written on a napkin. That's bullshit. Okay? I, Rob, I'm going to clean the windows, you're going to clean the doors, and that's it, and hallelujah. No. Guys, no. Absolutely not. You've got to make sure that you dot your I's and cross your T's. You've got to be so pedantic on that agreement that it's not even remotely funny. In fact, when you actually write or see the agreements that we do for you, yeah, a lot of people take offense because they are so detailed in making sure that there's no wires crossed at the time of conflict. Okay? So it's something that is really important. Furthermore, you've got to remember that it's not just about assurance. It's also about what happens when a partnership is dissolved. Now, in death and disability, you're dealing with the guy's estate. And you know that your partner's, that sweet, sweet, lovely little lady, that is his wife, that she's just, butter will melt on her mouth. That lady can turn out to be Cruella de Vil. She can turn out to be an absolute bitch from hell. And she can kill you, financially kill you. Because all she gives a shit about is getting paid out from that business. And if that business does not have the cash flow, she will liquidate you. You're going to lose your assets because you've not done your homework. And I see this every year. Okay? It's not. And ladies, please, I'm not misogynistic and having a go at you, because I've seen a lot of lady business people where their husbands are absolute complete bastards and take that business to the cleaners. It works both ways. Okay? So kindly don't take offense on that. So we spoke about step one, having the agreement. That's all good and well. But step two, which is equally important, if not more important, is that you've got to know how to value your business. And what you think your business is worth is bullshit. Up front, bullshit. Okay, because you're going to come with fairy tales. You think that this is the best thing since Christmas. Bullshit, man. You've got to be able to actuarially prove what that business is worth. So invariably what people do, they go to a business broker. Business broker says, oh, that type of business, you can ask for 2 times or 3 times your net annual turnover. And you merely go away and you believe him. Okay? Again, crap. He may be right. I'm not saying he's wrong. But it doesn't help talking about 2, 3 times. You've got to be able to understand, how was that calculation actually derived? How did you actually get to that? So there's certain steps that we do that you have to take cognizance of. So we always start with looking at if there's an existing annual financial statement, a registered official annual financial statement. You start with that. Now you know, and I know, that that statement is pure bullshit and fiction as well. If you're a good businessman, you're always going to try and make that as advantageous to you as possible. Okay? So that's, unless you're a public company. If you're not a public company, you're going to sharpen it up as much as humanly possible so that you're going to pay as little tax as possible. But we start with that as the fundamental. So that's fundamental number 1. Fundamental number 2 is then we extract from those figures everything that is to do with the shareholders, partners. Okay? We take it out. So in fact, what you do is you strip out all the salaries, all. And then you add back only the actual staff salaries, people that are not directors or shareholders. Okay? Forget about the word directors. the shareholders. So you put back everything other than the shareholders' drawings. That's number one. You also strip out any perks that the shareholders draw. The vehicle, petrol, telephone calls, overseas trips, whatever it is, clothing, the lot, telephones at home, entertainment, all of that. You strip it completely. And you only put back what is absolutely only relevant to the business itself. Okay? Not bullshit. Actual, where you had to have, I don't know, an entertainment allowance because of an actual business expense. Not because you wanted to go to wherever, Dubai, just to go and have, a job. And that's then now giving you a much better idea of what it takes. The third thing you need to do is then to put yourself in the shoes of a buyer. So let's say I want to buy your business. After I've done that exercise has got to be really accurate and very, very precise. I then look at it and I say to myself, okay, I don't want to run that business. Let's assume I don't. What is it going to take for me to replace you, who I'm buying it from? Do I have to replace you, one man, with generally more than one, because you probably work your arse off, okay? And whoever it is not going to work his arse off, so now I need to buy two people to replace you. But I'm buying them at the market value. What is it going to take to replace you if you're a salesman with a salesperson, if you're a technical guy with a technical guy, whatever it is, okay? I have to do that. Who's doing the books? Generally in a business, it's always one of the partner's wives or whatever the case may be. All right? What does it take to replace a good accounting person? Now, as long as I add that back in, now I come down to the real gross performance of that actual business. And then we deduct tax. And the tax that we deduct is we base it on personal tax, not company tax. And I will explain that separately when I see you as to why we look at that equation. Okay? But now we've got that figure. What we then do is we need to project that figure over the next projected income over the next 20 years. Now, I've forgotten to mention this to you because I need to maybe just take a bit of a step back. There are two ways of valuing a business. The one is on a net asset value. The other is on a projected income stream. And sometimes it's a combination of projected income stream and net asset values. Okay? Now let me explain quickly. Let's take a farming enterprise. Farming enterprise generally is valued on a net asset basis. Take the value of the farm, the land, the pivots, the tractors, all of that kind of stuff, the fencing, the buildings, all of that, minus all the liabilities, and you come to a figure, and that's your net asset market value. Okay? It's easy because you can bring in appraised assessors. You can, it's not very difficult to be able to value that kind of situation. Okay? But let's say you're a business that is selling chemicals or materials or, anything else. Often the assets are in the production of income, and the assets are not really great. Might be some vehicles, there might be a bit of plant, there could be a bit of office, computers, that kind of stuff. Now there, what you're doing is that you're doing it according to the income stream that you're generating. Okay? So what we do is we look at, when you look at your annual financial statement, there's certain things that we take into account and certain things that we don't. Okay? So here's a little example. This company has got, at time of valuation, it had certain cash in bank, got debtors and creditors, which you've got to take into account. There was no land. Movables, we do not take into account. Plant, we do not take into account. And vehicles, we do not take into account. We take into account the stock on hand, and the debtors, creditors, and cash. And that's it. That's all that we actually take into account. So although total assets were 1.9, all we're doing is taking 1.2 into account. So why did we exclude some of those assets? Because they are in the production of income. The vehicles, when you're selling a business, you're going to sell the vehicles with it, because that is what's generating the income. Okay? The plant, whatever the plant is, might be a mixer. That's part of the business. So you can't go and sell it. Otherwise, the guy's starting from scratch. Okay? So it's important to appreciate that. So once we worked out the net profit, that's after stripping everything and adding back a replacement person, we then look at the projected income. Okay? And here, we're looking at over 20 years, and you've got to look at a projected growth. Now, you may have different plans than the current owner. So you reckon, hey, you know what, I'm going to get a 10% growth here. And the year after that, I'm going to get 20% growth. Okay? Well, good for you. But sooner or later, you're going to have to come down to a steady projected inflationary growth, because you can only grow up to a certain point, and then it becomes pretty much inflationary. From that, we've got gross profit, net of tax, and then we bring it back always into net present day value. And from there, you then do what is called a average profitability, net profit, okay, after tax, over a 20-year period. The next step to understand is, if you're an investor, remember I told you you've got to put yourself in the shoes of an investment. So if I want to invest in your business, and I've got lots of money, 10 baht, I wish I did, but if I did, I know very well that I can put it in the bank right now 9-10%, money market account, and get that kind of money on 10 million. I also know, as a financial advisor, that if I put it into certain unit trusts and funds or shares, that I can possibly earn 15 to 20%. So why would I want to go and buy your business and have all the headaches and risk for anything less than that? If I was investing in a knock shop, a whorehouse, drugs, you name it, bottle store, anything of that nature, very high risk, okay? Never mind 15-20%, I want 1,000%, okay, return on my money, because the risk is so exceptionally high. If I'm going to go and buy a commercial shopping center, which has got key tenants locked in for the next 10 years, and I know that they've got steady income, I can say, all right, you know what, 20% I can live with that. If I'm buying your business, I've got to assess what is the sort of kind of risk that I'm going for. And generally speaking, I'll be looking at least 30 to 40% return on my money. And by that I mean internal rate of return. Some of you know what that means, some of you don't. More than happy to explain it to you in person. Okay? In a nutshell, it's the average return taking into account the highs and the lows over a given period of time. Okay? So that is what I want. So what happens is this. So let's assume that in this example, the average was 3 million, and I want 30%. How much money do I have to put in the bank or invest at 30% interest to generate that 3 million? Okay. And the answer in this particular case was 10 million. Okay. Came out to 10.5 was the figure that actually came out here. All right. Now on top of that, there we can now add in the assets that are part of, are sellable, in other words, okay, that are of value. So in this case 1.2, so it means 10 plus the 1.2 is 11. And that's what it is, the value there. Now this factor is very simply taking the 10 and dividing it by that figure there of 3, and that gives me then the 3.3. So it's 3,3 based on the actual projected income value. So it's 3.3 times plus net assets. Okay. And that's, at least then you understand how you are going to obtain that value. Then in this business, we've got 3 actual shareholders that are resident, different percentages, and each one now has that particular value. Okay, so shareholder A and B have to take out life insurance on shareholder C and pay the premiums. And shareholder C has to take out on A and B, and so on. Okay, and that's basically how it would. Probably cut myself off. So you understand, once you've determined the value, each shareholder according to his percentage, that's his valuation. All right? Okay, good. And then what then happens, once you've determined that, let's assume that now this is where the agreement plays a major role. The agreement has to be extremely, extremely specific. You don't do an agreement where you say, I'm leaving it to the accountant to work out the valuation. Bullshit, man. You don't want to do that. You really don't. Okay, because accountants die, they come and go. A lot of them don't know what the hell they're doing, believe you me. So you need to know what you're doing, and you need to determine it exactly. So what you've got to do is that the agreement speaks to exactly step 1, exactly what I said, annual financial. Step 2, step 3, step 4, step 5. This is the process. And the accountant can be the arbitrator in the event that there's a dispute in any of those steps. That's fine. But you've got to give him the clear-cut guidance as to the steps that has to be taken. And often, we talk about the annual financial statements. They may have been done 2 years ago. So you've got to take that plus your running management accounts. This is not for the taxman, you must remember. This is for your company valuation. So you've got to take the latest statements, be they official annual financial statements or management accounts that are genuine, and do what I told you, strip it, etc. So agreement, vitally important, making sure it speaks to that clearly. Then comes the issue of taking out the assurance to cover yourselves. So if you and I are going to be in partnership, I am going to take a life policy on your name, and I have to pay the premium. And you take life assurance on my name, and you pay the premium. Now, the agreements that are structured, that I offer you, if you go to an attorney to structure a partnership agreement, which is combined with a buy and sell in one, to the level and detail that I'm talking about, it's going to cost you between 150 and 250k, guaranteed. That is guaranteed. I'm offering that to you for free, on condition that obviously you're going to be doing business with me. Now, the agreement that I give you has been compiled over a period of 38 years, and some of the finest legal minds have put their hands in there, okay? And it's been chopped and changed and amended over the years so that it's really fine-tuned. Now, each agreement is bespoke, so the fact that we use that as a template and a base for Company A doesn't mean that that's what we use for Company B. Each one is adjusted. But what is not adjusted is all the clauses that deals with anything to do with the assurance aspect of things, be it partnership, be it keyman, be it contingent liability. It is critically important that it's structured correctly, because if not, what happens is that you do it half-assed, gets paid out, and then the taxman smacks you a state duty, or smacks you a massive amount of money, okay? And you'll end up losing out. Or you think you're doing a keyman, and you think that it's tax deductible, it's not, and then bang, you're going to be paying out a huge amount of money. So and don't for 1 minute think that a lot of the attorneys know exactly what to do. Okay? Just because they've got a degree doesn't mean that they are sharp in those specific areas. Okay? And with respect, obviously there are lots of them that do, but you be very, very, very careful and cautious. Okay? Now, trust me, we're offering it for free, and once we set it up, you're more than welcome to take it to your attorney to check. No problem. Okay? And we're more than happy to then liaise with him and adjust things that he may or may not like. So that's fine. Part and parcel of that agreement is your restriction of trade. Often people fall apart, Then partner A starts a business in competition with you, and then there's massive fights. So all of that is part of the agreement that we actually offer you. Mahala. Okay. And all of that, trust me, by the time we finish with it, by the time your attorney has checked it, you've got a pretty agreement that's pretty much cast in stone. Okay. The other thing is that company valuation should be done on an annual basis, if possible. And you should amend your cover on an annual basis. Appreciate that if we value this business now at 10 million, like in this example, and suddenly they have this heck of a run, and in 3 years' time it's worth 50 million, and you've only gone and insured a global amount of 10, well, you're equal in street. Because Cruella de Vil is going to come and look at you for the next 40. Simple as that. So it must be kept pace with the actual real value of that business. Be it on a net asset value, be it on an income stream value, you've got to do it properly, 100%. Right, so that's that. Then the other area that I can be of great assistance to you is to point out the areas where a lot of businesses fail. Predominantly to do with administration, talking about accounting, books, how you disclose and transparency between partners. I'm an extremely pedantic bastard, and I've learned the hard way, okay, is how you do your accounts, how you file your documents, how you file whatever. And are your partners able to view what you are doing? I'm a great believer in Dropbox. Okay? I'm also a great believer in doing things in a clear-cut, logical manner. So in Dropbox, you'd have a folder called Accounts 2024. You click it open, bounces open. It's got banks. Banks 2024. In there, you've got FNB, Nedbank, whatever banks you've got, whatever the accounts you have. You click that, you open up their statement for January, February, March, etc. All done in date format, backwards. In other words, the year 24, the month 01, the date 31. Okay? So that they are filed systematically, numerically, at all times. And we take it to the finest degree, where it is FNB underscore CUR underscore 24, etc. Because just one little thing wrong throws out your filing completely. Okay? Now, on a Dropbox system, it means that your partners have got access to that. Guy can go in, go click, 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 look at the statement, knows exactly what's going on. Same thing, you've got your creditors, okay? You've got whatever the creditor is, okay? Builder's Warehouse. So you've got Builder's Warehouse, all the invoices are entitled BW for Builder's Warehouse, underscore, either you do it by invoice, INV, invoice, underscore date, or date and invoice number. But same story, all logical and all straightforward. You produce monthly, be it through Pastel, QuickBooks, whatever system that you may use, your trial balance, your ledger, your creditors and debtors ledgers, all of that. And all of that have got separate folders, all recorded clearly. Your partners, whether they're in Hong Kong, China, Dubai, Joburg, wherever they are, can go on any device and go click, click, check, see exactly what's going on. Okay? All your reports, whatever the reports that you have. So we've spent 100,000 on this item. Why did I spend that thing? So before I shit myself, all I do is I go click, click, see, pull out the invoice and see exactly what you did. Okay? And that's, I can't tell you how critical important that is. The other thing is the analysis of a business. Your own analysis of a business. Especially when a business is multifaceted. That you've got Division 1, Division 2, Division 3. And generally, a lot of people, it's just one groot gemors. Okay? Just big melting pot. They haven't got a flippant clue as to what the Division 1 profit, what is Division 2, what is Division 3. Because it's totally mixed-matched. Hence, I take things possibly to the extreme. The coding systems that we use are very, very specific. not just administration. It's broken down in each item. The staff wages, welfare, uniforms, etc. We can even do it by cost centers. So if you employ old John has got a bakkie, and John is a contracts manager, and you want to know what John is costing you, then he becomes a cost center. You've got to have the ability to understand that you're analyzing John, his bakkie, the fuel of the bakkie, the oil of the bakkie, the maintenance of the bakkie, his RA, his pension, alles for John. That's your cost center. That's what he's costing you. And John has been attributed to the repair and maintenance of that contract. So when you're analyzing that contract, you're analyzing him as a cost center. Otherwise, what did that contract profit? How would you know? You haven't got a flipping clue if everything's mixed up. You can just suck thumb. I mean, there are other ways of doing it, okay? I mean, I know a guy, and God bless him. Me, I'm very analytical and sometimes way too honest. And, I analyze things to the death, and then I put in a 25% markup, and I'm feeling guilty because, I'm charging the daylights out of that particular person. I know a couple of guys that operate on a cell phone. I do detailed spreadsheets. They work on this thing. Simple cell phone. What did labor cost? 10 Rand. What did parts cost? 100. What does fuel cost? Another 100. What have I got? 1,000. No problem. I'm going to charge 10,000. Oh, great. If you can get away with that, well, hallelujah. But generally speaking, folks, you need to be able to analyze 100%. And this is where we can be of great, great assistance. Okay? So, end of this lecture, I would urge you to have a free consultation with me. Contact me on the email at the end of this video. You'll see the email and my cell phone number. You're welcome to make contact. We can meet online or in person. Let's see if I can be of assistance, and if I can, fantastic. You've got nothing to lose. If nothing else, you're going to get a second opinion, and believe me, you're going to learn something from me. Make no mistake. If nothing else, you will learn a lot, even if we don't do business. So I urge you to do that. I thank you for listening to me today. I'm sorry if it's taken too long, but it is what it is. And God bless, and may the Lord always, always shine on you. Keep well.